Then in part B, you need to prepare a memorandum to the Managing Director of Furniture Galore Pty Limited, where you can see there's two parts to the required over here. First, you need to explain the impact that each of the following changes will have on the NPV calculated. Your discussion should be in the following format. Okay, so guys, where they specifically tell you in the required to present your answer in a specific format, you must use that format. So for each of these changes over here, you need to explain the impact that that change is going to have on the net present value calculated. And then after that, you need to explain how an FEC or a forward exchange contract can be used to hedge currency risk. You should make use of the quoted rates provided in your answer. The calculations are not required. All right, and there's 1 mark available over there, and that is awarded for layout and structure. So guys, that communication skill mark is awarded firstly for presenting your answer in the format of a memorandum. So you must have a memorandum. So I'm going to look at that with you now. And in the first part of the required, you must have this table. Okay, so your discussion should be in this format over here. If you've done that, you'll get the communication skill mark. Let's just quickly look at how you present your answer in the format of a memorandum. So first, I recommend, guys, that you always just write memorandum. So then there's no doubt you are preparing a memorandum. It's clear to the marker. Start with that. This is a memorandum. Then, when you have a memorandum, you always need to say who it's to, who it's from. You need to give the date, and you also need to give the subject. And the subject is just what you're going to be discussing in the memorandum. So, who is the memorandum to? That comes from the required. You've been told to prepare a memorandum to the Managing Director of Furniture Galore Pty Limited. So it is to the Managing Director of Furniture Galore Pty Limited. From, who are you? You are a consultant working for JW Consulting. So just say consultant. Guys, don't put a name. You can't put your name because you're supposed to be anonymous when the marker's marking your paper. Now, at UNISA, you're not necessarily anonymous because your name does appear on the front page of your paper, etc. However, UNISA is trying to prepare you for the ITC, the SAICA board exams, your ITC, APC, and all of that stuff. When you finally get to those papers, your name doesn't appear anywhere. The marker is not allowed to know whose paper they are marking. So please, guys, if you use your name over here, or even a fictitious name, if you use a fictitious name, they don't know that it's a fictitious name. So then they have to go and check. The whole marking process comes to a halt. They have to go and check, did a person with this name write the paper? Oh, no, they didn't. It was a fictitious name. But you just waste the marker's time. And obviously, you don't want to upset the marker, guys. You want the marker on your side, on your team, giving you the marks. So don't put your name. Definitely not. Don't put a fictitious name because the marker doesn't know that the name is fictitious. So whatever your role is, if you are a CTA candidate, because normally that's what happens in the CTA papers, then you just write CTA candidate. If you're an ITC candidate, you write ITC candidate. In this scenario, I've told you that you are a newly qualified chartered accountant and you are working for JW Consulting as a consultant. So you are a consultant, okay? Nobody can make the mistake of thinking that's a fictitious name, so you're safe by doing that. Obviously include the date and then the subject. You need to explain the impact of possible changes on the NPV that was calculated. So the impact of possible changes on the NPV analysis and how an FEC can be used to hedge currency risk. So that's the subject. Then, please, if you just scroll down, you must also always have a conclusion. So right at the end, you'll see I've got a conclusion over here. You must always have a conclusion. So you can honestly just say, contact me if you need any further information. If you're running out of time, that's perfectly fine. But again, say that this is a conclusion so that the marker goes, boom, there's a conclusion, okay? He doesn't have to guess. Don't just have some little sentence that they have to look for and it's an obscure little sentence that no one can see. Label it as a conclusion. This is my conclusion. I trust you find the above helpful. Please contact me should you require any further information. There's no doubt that that is your conclusion. All right. So if you've done that, and if you also have your discussion for part A in this table, you can get that communication skill mark. All right, so let's look at answering the first part over here. You need to explain the impact that each of the following changes will have on the NPV calculated. Now, what I'm going to do, guys, is I've drawn up an NPV table with the useful life of the project so that I can discuss this with you, because it's more important for me that you understand where the solution comes from and the logic behind the solution. You can all read the solution, so I'm not going to write the solution out. I never write out written things in the solution because you're literally going to sit there and watch me write things out. You don't learn anything from that. So I never write out things that are discussion type things. What's more important for me is that you can see how I get to that discussion so that you are able to get to that same discussion. Okay, you don't have to watch me write out the discussion. So I am going to use the suggested solution, but I'm also going to show you with a calculation and with the format of a calculation, I'm going to show you the logic behind where all of that discussion comes from. So let's just go back to the scenario just to refresh ourselves over here. So Furniture Galore is a manufacturer of custom-made luxury furniture. The managing director wants to purchase a new technologically advanced manufacturing machine, which will be imported from the United Kingdom at a cost of £4 million. The machine is going to be purchased immediately, but will only be paid for in 90 days after they've tested the machine. It's going to be depreciated over its useful life of 10 years. The SARS allowance is the Section 12C allowance on a new machine, which is 40% in year 1 and 20% over the next 3 years. The junior accountant has calculated that the investment in the machine will yield a positive net present value. So we know that this investment has a positive net present value. So obviously they want to invest. However, the managing director has some concerns about how some of these inputs that go into that NPV calculation, if some of these things change, what impact will that have on the NPV that's being calculated? So the first thing that he is concerned about is the deterioration of the rand. Now, obviously, this is important because the machine is going to be imported from the United Kingdom and is going to be paid for in pounds. The cost is £4 million. So the problem is if the rand deteriorates over the next 90 days before they have to make payments, the machine's going to cost them more. So what impact will this have on the NPV that's being calculated if the cost of the machine is more? All right, so this is the table that I've drawn up just for discussion purposes. You can see first we have the NPV analysis, and you can see because the machine has a useful life of 10 years, I've got from year 1 to year 10. But remember, you always have column 0, which is the beginning of year 1. So this is the beginning of year 1. That's the end of year 1, end of year 2, end of year 3, end of year 4, all the way up to the end of year 10, etc. And then just below, you can see I've got the tax calculation. So that when we are discussing the impact on the NPV analysis, we also take the tax consequences into account in our discussion as well. Because obviously, your tax calculation, whatever you get here as your tax cash flow, that's going to be included in your NPV analysis above. So it will have an impact on the NPV that's calculated. All right. So firstly, what we need to do is we need to consider how the deterioration in the rand is going to affect the net present value calculated. So the machine is going to be purchased or imported from overseas, and it's going to be paid for in pounds. The cost of the machine is £4 million. Now, we know with a capital investment appraisal, right at the beginning of the project, the cost is going to be a cash outflow. Now, if they pay for it now, we're going to have one cash outflow. But what he's worried about is if the rand deteriorates over the next 90 days. Now, if the rand deteriorates, obviously, guys, it's going to cost them more in rands. The pound amount is going to stay the same. The machine costs £4 million. However, when it's converted into rands, if the rand deteriorates against the pound, it's going to cost them more in rands. So we need to consider what that impact is going to be. If we are deducting a bigger amount here, what impact is that going to have on my NPV that I'm calculating? So if we have a bigger cash outflow, that is obviously going to cause the net present value to decrease. Because you have a bigger cash outflow, the net present value will go down. However, you do also need to consider the tax consequences. Remember, guys, you were told that SARS is going to allow a Section 12C allowance of 40% in year 1, 20% in year 2, 20% in year 3, and 20% in year 4. So obviously that allowance is going to be based on the cost of the machine. So if the cost of the machine goes up, the Section 12C allowance is going to be bigger. Because it's based on a higher cost. So let's say, for example, the cost of the machine is 80 million Rand if they pay now. So I'm assuming an exchange rate of £1 is equal to 20 Rand. Let's assume if they pay now, the cost of the machine is 80 million Rand. Then obviously in year 1, they're going to claim 40% of 80 million, in year 2, 20% of 80 million, etc. However, let's assume that over the next 90 days, the exchange rate deteriorates and it's no longer £1 is 20 Rand, it's now £1 is 21 Rand. Then instead of the machine costing 80 million Rand, the machine is now going to cost 84 million Rand. So obviously we know the cost is higher, so the NPV is going to be lower. But if the cost is higher, then your Section 12C allowance is also going to be higher, because in year 1, they're going to claim 40% of 84 million Rand. In year 2, they're going to claim 20% of 84 million Rand. Now, if you have a bigger allowance over here, that's going to reduce your taxable income. So the taxable income over here is going to be less because you have a bigger Section 12C allowance. So we are going to take that taxable income and multiply it by 28% to get the tax cash flow, which we are going to include in the NPV analysis above. Now, if taxable income is decreasing, and taxable income is decreasing because your Section 12C allowance is larger if the cost of the machine increases, so taxable income is going to decrease, which means your tax cash flow is also going to decrease because you're taking this amount over here and you're multiplying it by 28%. So if taxable income decreases, your tax cash flow will also decrease. So what impact is that going to have on the NPV calculated? If they are paying less tax, so this amount here is smaller, the amount that they are deducting over here is smaller because your tax cash flow is decreasing. That is obviously going to cause the net present value to increase. They're paying less tax. That will have a positive impact on the net present value. So what's the net effect? The higher machine cost is going to cause the net present value to decrease. However, because of the tax consequences, that's going to cause the net present value to increase. The net effect is the net present value is going to decrease. Why? We include 100% of the cost of the machine in our NPV analysis. The total cost of the machine will be included in the NPV analysis. However, we don't include the total allowances in the NPV analysis. We take the taxable income over here and we multiply it by 28%. So only 28% of those allowances are included in the net present value analysis. So this holds more weight because 100% of the cost is included in the calculation. However, only 28% of the tax cash flows are included in the calculation. So the net effect is the net present value is going to decrease. Let's jump to the suggested solution. Okay, so if the rand deteriorates, how is that going to impact the net present value? It will cause the net present value to decrease. Why? If the rand deteriorates, the acquisition cost of the machine, so in other words, the initial outflow is going to increase, which will cause the NPV to decrease. If the machine costs more, that will have a negative impact on the net present value. However, If the machine costs more, that will result in higher capital allowances, which will decrease taxable income. And if taxable income decreases, your tax cash outflow is going to decrease. And if the tax cash outflow decreases, or if the company is paying less tax, that will obviously have a positive impact on the net present value. It will cause the net present value to increase. What is the net effect? The net effect is the net present value is going to decrease because the full machine cost, 100% of the machine cost, is included in the NPV calculation, whereas only 28% of taxable income is included in the NPV calculation. So this holds more weight over here. So overall, it is going to decrease. Next, if the SARS allowance changes to 20% per annum over 5 years. So they're looking at buying a new machine, and the SARS Section 12C allowance on a new machine is 40% in year 1 and 20% in the next 3 years. How, if this changes now, because they decide to rather buy a more advanced second-hand machine for the same cost? If it's a second-hand machine, the SARS allowance is going to change to 20% per annum over a period of 5 years. So how will this impact the net present value calculated? Once again, let's jump to our tables. All right, so if they purchase a new machine, SARS is going to allow a 40% allowance in year 1 and then 20% in years 2, 3, and 4. On the other hand, if they purchase a second-hand machine, then SARS is going to allow a 20% allowance for 5 years. All right, so let's focus on the differences between the two. You can see the SARS allowance in years 2 to 4 is exactly the same in both situations, so we can ignore that. The only difference between the two is if they buy a new machine, they get a 40% allowance in year 1. On the other hand, if they buy a second-hand machine, they're going to get a 20% allowance in year 1, and then the other 20% allowance they're going to get in year 5. Now, guys, it's important to note that over the full period, they are still going to get allowances for the total machine cost. So over the period, they will still get tax deductions for the total machine cost, regardless of whether it's new or second-hand. Because you can see the sum of all of these percentages in both cases adds up to 100%. So they are still going to be able to get tax deductions for 100% of the cost of the machine, the total cost of the machine. However, the only difference between the two is if they buy a new machine, they get a 40% allowance in year 1, whereas if they buy a second-hand machine, they get 20% in year 1 and the other 20% only in year 5. So what we need to discuss over here is the impact of time value of money, because we just have a timing difference as to when they are going to get this extra 20%. Either they are going to get it in year 1 or they are going to get it in year 5. It's just a timing difference that we're looking at. Now remember, guys, these tax deductions that you're getting over here are tax benefits. This is a capital allowance. So the company is going to use these capital allowances in order to reduce the amount of tax that they need to pay across to SARS. They're going to calculate their taxable income and they get a tax deduction over here. So these are tax benefits. So the question is, do you want a 40% benefit in year 1, or would you prefer to split that? Do you want 20% of the benefits in year 1 and then 20% of the benefits in year 5? Now, another way to look at this is, let's assume someone wants to give you 100 Rand. If someone wants to give you 100 Rand, do you want the 100 Rand 1 year from now, or do you want the 100 Rand 5 years from now? Any logical person is going to want the money in year one. You're not going to want to wait for the money for 5 years, because remember, guys, the value of that money is going to deteriorate over time because of time value of money, because of things such as inflation, etc. So it's much better to take the 100 Rand in year one instead of taking the 100 Rand in year 5. It's worth more to you in year one than what it is in year 5. So following the same logic, you should rather take the 40% tax deduction in year one, because obviously you're getting the benefit sooner, instead of taking 20% in year one and 20% in year 5, because the benefit is worth less in year 5. So if the allowance changes to 20% per annum over a period of 5 years, that is going to cause the net present value to decrease, because the company is getting the tax benefit later. And because of time value of money, that will cause the net present value to decrease. Okay, so if the SARS allowance changes to 20% per annum over 5 years, the net present value will decrease, because they will now be paying more tax earlier, because instead of getting a 40% tax deduction in year one, they're only getting a 20% tax deduction in year one. So they'll pay more tax in year one. And obviously they're going to be paying less tax in year 5, because they'll get a 20% deduction in year 5. But remember, because of time value of money, you want that benefit sooner on. If they are getting the benefit later on, it's going to cause the net present value to decrease, because the value of money deteriorates over time.